Hello everybody, Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is Friday, September the 20th. The month is almost over here. We got basically 10 more days left. Things are happening fast. Yet another busy and interesting week in housing and real estate. We'll get into it right now. First of all, if you'd like to learn more about real estate, the housing market, what's going on with our news updates and the stuff that we do, please subscribe to our channel. We'd appreciate that very much. All right, today on the news wire agenda, we're going to talk about existing home sales. We're going to talk about Fed interest rates. We're going to talk about new home starts and some other things as well too, with respect to mortgages and things like that. Also, some home flipping news came out this week, so there's a lot to get into right now. Okay, so basically, NAR, of course, released this week, which was the August 2019 existing home sales. And I'm sort of looking at this as, kind of like the calm before the storm. And why I'm saying this is we shouldn't get fooled by what we've seen. So we saw a slight uptick in July, and now we have August numbers, and guess what? We see another slight uptick in existing home sales for August, which should not come as a surprise. And I like to be clear here. This is not, having 2 months of an increase, albeit a very small increase, is not the next, it's not saving the real estate industry whatsoever. This is an expected increase because, as we've always spoken about, and I've maintained this position since early in the year, is that we're going to see home sales slow down. We're going to see our seasonal summer selling season. So that's a tongue twister there. The seasonal summer selling season comes into play with some increases because that's where a lot of people buy and sell homes. And guess what? Once that occurs, then we start seeing a little more rapid pace on slowing home sales and price and value drops. So that's kind of where I believe things are headed here. So that's why I say don't get fooled again just because we had 2 good months in a row. And the good months they're incremental months. So if you take a look at this here, existing home sales increased 1.3% in August. And that basically is compared to July, which is, okay, it's an increase. It's not 5%, it's not 7%, 10 double-digit increases. We're looking at 1.3% month over month. And the year over year compared to August of last year was about 2.6%. So this is an uptick, which is great. Is this due to lower rates? Probably. Is this due to the, I think there's a combination of a lot of things here. I think it's just, again, the seasonality of people buy and sell, they relocate, and they do it just before it's time to, register kids for school and things like that. We see the flurry in the activity, and everything happens just before Labor Day. Now, granted, other parts of the country, school starts earlier. Down here in our region of the South, they start, sort of second week of August. Obviously, we know in other places across the country, it's usually the day after Labor Day. So again, we tend to see the July and August increases, and we shouldn't be fooled with what's going to happen in the future. So just to put things in perspective, though, the regional breakdown: August existing home sales in the Northeast increased 7.6%. Midwest sales grew 3.1%. Existing home sales in the South grew 0.9%, and existing home sales in the West declined 3.4%. So we actually had a decline in the West, and we all know that there's a lot of things happening in the western part of the country. We know there's a lot of relocation going on. People are moving inland, and they're shifting where they like to live to cheaper homes, less tax burden states, et cetera, et cetera. So you want to keep that in mind, that definitely things are shifting. But again, we see other parts of the country, I guess say moderate increases. The South, small increase. West, definite decrease here. All right, so the national home sales grew. The median price was $278,200 for the month. And when I take a look at the summary here, so of course, and I'll put the link to this. So NAR publishes this data. This is all available to you. Basically, when you look at, for me, we've had a number of months in a row of year over year sales decline. So we've had a small increase in July, a small increase in August. So there you go. Market conditions out of the, so we break down, or NAR breaks down, NAR, National Association of Realtors, breaks down the market conditions of who's buying and who's doing what. So first-time home buyers made up 31% of the sales, about the same as last year. Sales to investors actually was 14% of the sales, which was up a point from the year before. Cash sales was 19% of all sales, down a point from the year before. Distressed sales was 2% of overall sales, down from 3% the year before. And again, distressed sales are sales of short sales, and we'll call it foreclosed on property. Those are called REO, real estate owned. Those are homes that have been foreclosed on and taken back by the lender and then put back on the MLS, multiple listing service, to be sold. So that's the two, and typically REOs are more than 1% of the two, and more than half, and the short sales typically are less than 1% of all the overall activity, which is a shame, and we can talk about that in the future. Existing home sales by region, the volume: the South had 42% of the sales, the Midwest 24%, the Northeast 13%, the West 21%. Housing supply, looks like we're down to, I believe, we dropped from a market inventory of 4.3% to, 4.3 months to 4.1 months. So again, that's comparing the year August 2018 to August 2019. And again, sales by price range. The majority of the sales fall in that 250 to 500K range. 38% of the sales there. 37% of the sales are between 100 and 250K, and just 7% of the sales are $0 to $100,000. Again, anything over $500,000, $500,000 to 750 is 11%, 750 to 1 million is 4%, and 1 million above is 3%. So there you go. So really, the majority of sales are coming in that 100,000 to 500,000 range, which is not surprising. So again, just, like every month, the range that suffers the most is the 0 to 100,000K, the affordable housing, the smaller priced homes. Basically, each year, the percent change in sales, each month, it decreases big time because there's less available. So those sales were down 16.4%. And the sales from 100 to 250K, those sales were down 3.8%, just because, again, affordable homes and volume inventory issues there. So there you go, people. Now, to tie this in, which is kind of interesting, is we're actually taking a look at this with respect to, I guess you could say, housing starts. So when we look at the new home building, so America's housing starts spiked to 12-year high in August, which is kind of cool. So housing starts spiked 12.3% in August. That's according to Department of Housing and Urban Development and Department of Commerce. August housing starts are now 6.6% above last year's rate. So that's good news, and they basically are saying there's a combination of things going on here. Clearly, they say lower interest rates have helped to move that forward. I know a lot of builders out there. The median price for new home sales is down. Builders are offering incentives, all sorts of things. They roll in, hey, use our financing and our title company. We're going to roll in, I guess you could say savings or rebates or free stuff, free amenities, free upgrades, whatever. So they're doing what they can to get the new home sales kicking here. So just realize that. But when you hear a 12-year high in August, a lot of us think new home sales as being a single family home, but it's not. The new home sales, when they talk about housing starts, that you break that down into single family and multifamily. And what we do sometimes is we find that multifamily tends to boost the overall statistic numbers because a lot of multifamily development is going on right now. So single family starts rose 4.4% from last month, while multifamily starts surged almost 31%. So there's certainly a difference in percentages there. Overall permits rose 7.7% seasonally. So single family permits increased 4.5%, but multifamily grew to almost 15%. So really, the multifamily growth is doubling or quadrupling the single family growth as far as starts and permits and things like that. So please keep that in mind. So again, when I say don't get fooled again, this is about America housing starts spiked to 12-year high. But you take a look at that, multifamily to me is complexes, which will be apartments, rentals, things like that. Not necessarily single family homes to be purchased for primary residential living, so to speak. So that's why there's always a difference there. So even though it's good news that there is some increase on both fronts, realize that sometimes the multifamily does drive the numbers a little bit higher. All right, now going to mortgage rates. So clearly this week, all news and all the eyes were on the Fed. The Fed actually announced the other day that they were decreasing their interest rate 25 basis points, and people are wondering if, of course, if you look on the news wires and all the videos, all the information out there, people are commenting, is this the start of another quantitative easing cycle? A lot of liquidity has been pumped into the market by the Fed, so there's a lot of financial people who are analyzing this and giving their commentary. I refrain from that because I'm not a financial, even though I understand a lot of it. I don't think I'm, we'll call it skilled enough or have the credentials to comment on that. So you can look at what's going on. But as far as I'm concerned, does this mean lower rates? So the number one question, when the Fed drops rates, does it mean that mortgage rates are affected? But actually, no, because this just came out today. So mortgage rates increase just as home sales activity regains momentum. So we see some, new house sales starts picking up, and now we see that in July and August, existing home sales kind of got a little bit of an uptick there, again, based on seasonality. So of course, people like that and they want to run on that platform and that wave. But mortgage rates rose, on a weekly basis for the second week in a row, potentially threatening to put a damper on home sales just as the real estate market's outlook was starting to brighten, which is kind of interesting. So what it boils down to is the fact that, this is confusing for some people because I just heard that the Fed dropped rates, and the Fed dropped rates back in July. So shouldn't this be a positive thing? Well, the Federal Reserve, when it cuts interest rates, is adjusting its short-term lending rates. Mortgage rates, on the other hand, are roughly track the direction of the 10-year Treasury note. So those are two different kind of rates, or we'll call it points where mortgage rates track. And I guess for housing mortgages, they're not tied as close to when the Fed drops their overall rate 25 basis points. So there you go. So that's the reasoning why, even though we see some, I guess you'd say monetary policy, potential quantitative easing, and we'll call it just the impression we get is, oh my gosh, rates are going down. That's got to actually kind of flow through to housing and mortgages. Well, sometimes that doesn't always match up. Now, could rates eventually drop in the future? Of course they can on the mortgage side, but it's just interesting to note that sometimes what happens in the financial markets doesn't always equate to the same thing in the housing and real estate market. So I do find that, it's for a lot of people that's it's doesn't make sense or doesn't correlate properly, but that's the way it goes these days. So again, but I do believe that rates will probably still hover and remain, if not dip a little bit in the future. Mortgage rates, that is. Okay. Adam Data Solutions releases their home flipping information. I guess the big headline is home flipping returns. Returns mean the money you get back from your investment falls to an 8-year low. So basically, flipping rates decline after spike in Q1 2019. Total dollar volume of homes flipped with financing reaches $8.4 billion, a 13-year high. So according to Adam Data Solutions, the Q2 2019 U.S. home flipping report that they produced shows almost 60,000 single-family homes and condos were flipped in the second quarter of this year, 2019. That's up 12.4% from the previous quarter, which was Q1, but down 5.2% volume from this time last year. And the reason being because there's just probably less homes to flip and less homes for investors to get their hands on. So the homes flipped in the second quarter represent 5.9% of all home sales during that quarter, so including everything that goes on there. So flipping is roughly almost 6%. All right, it's down from a post-recession high of 7.2% from Q1, but up from 5.4% from a year ago. So we're kind of still hovering there. Now, the interesting part when they say the return, so your gross margin has been dropping. Homes flipped in Q2 2019 typically generated a gross profit of $62,700. This is the difference between the median sales price to purchase and the median price paid by investors to acquire. That's up 2% from the previous quarter, but down 2% from a year ago. So there you go. So we're seeing a little bit of erosion there. Home flipping keeps getting less and less profitable, which is another marker that the post-recession housing boom is softening or maybe coming to an end. So this is from the Chief Product Officer of Adam Data Solutions. He says it's flipping homes is still a good business to be in, but profits are healthy in most parts of the country. But there's a lot of forces in the housing market appear to be working less and less in the investor's favor. So I do think that's interesting to note. So people like this guy are saying that, hey, we see that this housing market is softening. Home flipping rate up from a year ago in 70% of local markets. So we know that with respect to all the activity, with respect to more mom and pop investors, more institutional investors out there, people just trying to do this on the side. There's a lot of activity. So so the flipping rate is up in 70% of local markets. That's the activity, the number of homes that are flipped. And again, you know that you can on the weekend or even during the evening time put on your television and you can, or internet, and you can scroll through all the channels and you find 150 to 200 different shows on flipping homes, buying homes, small homes, reclaiming homes, whatever. There's lots of real estate shows out there that tell you how to do things and show you the money that can be made if you are so successful. So keep that in mind. It's funny that among the areas analyzed, the number of homes flipped reached new peaks in Q2 for 10 MSAs. The largest were Charlotte, North Carolina, San Antonio, Texas, Pittsburgh, Pennsylvania, Oklahoma City, Oklahoma, and Raleigh, North Carolina all had flipping peaks. But also, what's just kind of interesting is that home flip lending volume up 31% from a year ago to a 13-year high. And this is where I find it very interesting and almost risk factor here. So back in the day when I mean the last housing crisis, when there's a lot of flipping that was going on, it was flipping homes and mortgages were still fairly tight and they weren't loosened and there wasn't the lending availability for the investor market out there. So typically if you're going to buy a home as an investment property to fix and flip or to cash flow rental, you had to put down some money, you had higher interest rates, so you had to afford to be able to do that. Well, nowadays, and I can tell you this because I've subscribed to a lot of different email services and I like to listen to what's going on in the marketplace, see what's online, etc. So I know that on any given day, I'm probably getting between 2 and 5 emails that are coming to me from people saying, we've got home flipping products, finance products for you here. So there's a whole other market for today's real estate investor that's offering financing that really wasn't there back in the last housing crisis or pre-housing crisis. So you have to keep that in mind. So home flip lending volume up 31% from a year ago to a 13-year high. The total dollar volume of financed home flip purchases in the second quarter was $8.4 billion, up 31% from $6.4 billion in 2018, the highest level since Q3 2006. So we've hit a new peak here, which means people are buying. Now, the concern I have is, if we're peaking in 2018 and 19 as far as home values are concerned, and we have all this lending going on, so people are buying homes at higher and more expensive rates or prices, because we know that affordability is low, and we know that prices are up, and we also know that costs for flipping materials, for rehab materials, are higher these days. So to me, that just is another sign of risk for the marketplace. And we also have seen, I just talked about it, that the flipping return is going down. So what happens in this type of market is you have prices get pushed up, costs are up higher, more people that are doing this. Some people are we'll call it either inexperienced or uneducated, which means they're going to take more risk. We have more investor funding going into this, which means there's more risk, less of your own money, more of somebody else's money, which is another risk factor there. And I can tell you that the where was it here? I've got it somewhere down here. The number of days, or the average days to flip a home, is actually increasing. It's 184 days. So that's basically, it's more than 6 months. It's gone up from 180 days last quarter or last year. So my point here, and this is really kind of a very succinct point, is the fact that I like that word because someone commented and said, be more succinct in how I speak. So I'll try to do that right now. But the whole point is that the risk factor. So if we know that we are in a peak market that's actually starting to show some declines, if we know that it's taking 6 months on average to flip a home, and we know that flipping profit is down, to me the most risky position to be in as a newer or inexperienced investor when you're being presented with a deal from a wholesaler who's saying, oh, you can buy this home for $100,000. We think that the ARV is $150,000. We think there's $25,000 worth of repairs here. You've got $25,000 of equity. Have at it. Well, if you're buying fix and flip properties or looking at ARV, which is after repair value, that's a future number, more than 6 months out, because we know that the flipping average is more than 6 months. In a potentially volatile market, that is the most risky thing you can do, especially if you're taking financing. All right. So this is where people are going to get pinched and will cause some more problems in the marketplace, because I can tell you that sometimes the emotions will take over and people will buy property for these projects just because it's harder to get deals these days. And if you got your hands on one, you're just going to get it because you want to do one and you want to make a profit and you want to get this business going. But for me, that's dangerous because of all the factors we just mentioned. 6 months down the road, if the market changes 5 or 10%, there goes that implied virtual paper digital equity that you were sold. And if your timing to complete the project runs longer, your cost of money runs longer, or it costs more because you're running longer than anticipated. That's cut into your margin. That's a recipe for disaster. And I can tell you that most of these fix and flips are being done by we call them non-professional, the ma and pa group. Usually 60 to 70% of flips are done by that group. Nothing wrong with it. You got to start someplace, but clearly the corporations or the investors who are doing multiple flips per year, per quarter, they have their financing down, they've got their marketing down, they got their buy price range better, they're better at negotiating, getting deals from sellers. It's a machine. They've got cost structure in place, they've got contractors in place, so they can crank stuff out quicker, faster, cheaper than the average or inexperienced person, and that's where the difference is right there. So please, when I see this, I kind of go, okay, this is again a potential. And again, I'm only talking about this because when I talk to other investors out there who are looking for advice or on my input, that's what they're showing me. And my first question is, okay, did you verify that after repair value? Okay, how long have you built in a buffer where that value could slip? No, you haven't. Well, I think you better, because the market, you don't know where it's going right now. But I can pretty much say that the market is trending down as opposed to trending up. So that should be the first clue for people. So just keeping that in mind, realize that. Going back and forth, so I'm seeing a lot more information on the foreclosure world now, and more of it's actually being generated and being put out in the marketplace, which is cool. And I'm seeing things locally in our market, which I don't call it troubling, but shows a change in what's happening. So some of the first things I'm seeing, at least here locally where I am in the greater Tampa market, is I'm seeing foreclosures going faster. And what I mean by that, a lot of people tend to believe if they get a foreclosure filing, they can sit in their home for a year, 2 years, 3 years, 4 years, whatever they think. That may have happened and occurred back in the last housing crisis over the years because of factors that were uncontrollable. Lenders had too much volume. The court systems had too much volume. We couldn't keep up and recover. So a lot of people did get lucky and were able to stay in their property for a lot longer than they really should have. So that's good for them. All right. But what we're seeing now are things moving faster. So right now I'm seeing foreclosure filings that have sale dates that were filed in 2019. Which that's the first time, I see this happening in the summertime now, going, okay, that's picking up. So what that means to me is the lenders are becoming more aggressive on taking things to foreclosure. They have better systems, better staffing, better control on the information. That's going to move things along faster. And they have an incentive to dispose of a non-performing asset. And that's kind of the headline I'm talking about here. It says, dispose distress early to minimize loss severity. So I've talked every so often about the lenders, banks, non-lenders, servicing companies, whatever, people who are involved in the mortgage industry that are working on the notice of default or pre-foreclosure area. And it's been widely written now that the number one way for them to recover money is to take it to foreclosure sale and to have a third party bidder buy it and take it off their hands. It's the number one way for them to get their money back, get some money back, reduce exposure, etc. So it works in a number of factors. If it's sold at the auction, all right, they're not having to take it back as an inventory item. No, they don't have to go and secure it and have a holding cost for that. There's also some liquidity issues when they have so much, property under, value property as an REO under foreclosure. It does affect their ability to the money they can lend on the other side. So there's a bit of an equation on that they have to look at. And just the fact that, REOs, real estate owned, that's sitting there, tends to take time to go through the bureaucracy of the bank and the lenders, and they deteriorate quicker. They become and they sell for less. So there's not it's a loss position for the lender. So they want to take this stuff faster to the foreclosure sale and move that process forward. So basically, this is according to Fannie, economics of economic and strategic research at Fannie Mae. Basically, the earlier the creditor is able to dispose of the property, and the less they lose because of better maintenance for the property, for example. So REOs experience biggest losses. So basically, the specific distressed property disposition strategies analyzed and studied were short sales, deed in lieu of foreclosure, which basically, for those who don't know what deed in lieu means, is that it's called a soft foreclosure. You essentially sign over the home to the lender and they get it back quicker. They don't have to go through the problems or the costs and issues of actually taking you to the foreclosure sale. It's still a foreclosure on your credit, so it's no benefit to you, more of a benefit to the lender. And sometimes it's also referred to as what's called cash for keys. So people just go, I'm just giving it back. The lender may say, okay, hand us over sign the deed over to us, hand it over to us without damaging or stripping the property out. We'll give you a few $1,000s to move out and then go on your merry way. That's a deed in lieu of foreclosure. So again, still a foreclosure. Don't think it's not doing you any benefits, it's doing the lender benefits. So keep that in mind. They also looked at third-party auctions and also sales of real estate owned, whatever. So basically, it boiled down to that the loss severity was highest at the REO level, followed by the deed in lieu level, short sales, and finally third-party sales of foreclosure auctions. So that's the scoop on that. So they want to take it to, so the best thing for them is to take it to the auction, have a third-party bidder, take it off their hands. The next best thing is a short sale. Now, however, when you speak about the client, the homeowner, that's the best thing for them is to do a short sale, because a short sale becomes a settlement, which is better than a foreclosure or a bankruptcy. And a settlement means that you go into the transaction eyes wide open with some flexibility. And typically in the settlement, they agree to waive the right of deficiency, which means there's no deficiency judgment, and they won't come after you and pursue you for that difference, which they're doing a lot more these days, and they're being very aggressive of it. So for those of you that don't know, a foreclosure does not just wipe out your debt, all right? It does create a deficiency. The lenders are staffed and ready to come after you, or will sell the debt and somebody else will come after you. It's not a nice thing to have happen, so keep that in mind. So really, and again, funny, all we hear now is about lenders and what's best for the lender. No one's talking about what's best for the homeowner, and that's the difference. So really, if you think about it, homeowner is the best scenario. And I can tell you, based on our experience over the years, that we've had many, well, not many, but numerous times where, for whatever reason, the lender decided to take the foreclosure path versus the short sale path. And in the end, what it was sold for as an REO was less than what the short sale offer was. So they actually hurt themselves and actually, lost money in that capacity. So, again, as they say, your REO is the worst case for them. It's the most costly, the less profitable, so to speak. So keep that in mind. So anybody out there considering letting your home go to foreclosure, don't do that. Contact me, talk about a short sale, because it's the better way all around. But it just goes to show, and why I say this is that this is what's going to happen. Okay, there's more of this going on here. We're seeing a shift in the pre-foreclosure market and a propensity to take things quicker and push it through faster, so it's not sitting there longer and they're having less losses. So that's where they're at on things. So I wanted to convey that and keep that in mind for whatever you do in the future with your housing or real estate investor opportunity. So that's it for today. Have a good weekend. Thank you once again for the views. Thank you for the likes and the comments. If you want more information about real estate at any capacity, please send me a direct email. As I always say, it's getting busy now, guys. I'm feeling the pinch, and I got a lot of stuff on the go here, so I will try to get back to you. Hit me up a second time if I've not responded to you. I know I've got a slew of people that we've been playing some tag back and forth. The process really is to email me, give me your phone number in the email. That way I can text you or call you when I've got a chance, and we can either set something up or we can talk then. Some of you have a little more elaborate questions, which may take me a little longer to get to. But in the end, it boils down to, we're looking at never paying retail ways to, reduce your cost, reduce your exposure, methods to purchase property that are more cost effective than retail sales. So keep that in mind. And again, having said that, everyone have a great weekend. Look forward to speaking with you next week.